So please refresh your browsers. Good evening, everybody. It's 7 p.m. here in Bangkok, Thailand on the 23rd of April 2015, and it's a really exciting milestone today. Today is our first Meet the Authors free webinar with one of our new authors into the site, and this guy, he's amazing. It's Mr. Andrew Stotz. He's the CEO of Stotz Investment Research. Now, Andrew is also the president of the CFA Society here, and rather than me telling you who he is, I think I'll quickly get Andrew once again to introduce himself, and then I'll hand it over to Andrew because I know he's got plenty prepared for you, but really this is your webinar. So for the rest of the webinar after Andrew's segment, this is all about your questions, all your finance investment questions. You'll be able to ask to Andrew. He's the man, and this is a great opportunity to be there with Andrew. So over to you, Andrew. Welcome, and thank you for joining us today.
Great, Stuart. It's great to be here and present to everybody. Basically, what I'll be talking about is my course, which is about your 12 steps to financial freedom and financial independence. And basically, this is a topic that I've been looking at for a long time. My original experience was as a institutional broker, institutional salesman and analyst, that I was basically taking ideas and selling them to institutional clients. That means people that are managing huge amounts of money around the world. And so I kind of saw the whole world of finance from that angle. I studied finance in undergrad, and I did an MBA, and then I went to work in finance most of my career, and I've taught finance most of my career. So finance is really in my blood, and I enjoy it very much. In fact, right now I'm just working on my PhD in the area of finance. And so this whole course that I'm going to talk a little bit about tonight and then take some questions really came out of an interesting challenge I had, and that was that I have 5 nieces, and I thought the best gift I could give them is to teach them to be financially independent. But I knew all about that because I've got a background in that area. And basically what I did is I had to sit down and try to think, how could I simplify everything that I've learned? And this course is really coming out of that, Stuart. What I did is basically put everything down that I knew and then try to simplify it into what matters. Really, as we know in life, you know, when you think about art, maybe you may think about the primary colors. You know, 3 colors really matter. Other things are incidental. They add some benefit, but is it enough benefit that we should be talking about? So what I've tried to do is hone this down over the last, let's say, 4 or 5 years to a message that's as simple as I can possibly get it without being more simple than that. So Stuart, that's kind of a background on me and what I'm doing about the course.
So that's really exciting. And actually on Jcademy here, you'll be able to see coming up now, as of today, we have Andrew's latest course on Jcademy. It's called 12 Steps to Financial Freedom. And that's basically what Andrew's going to be preparing for us today. Andrew's been putting this amazing content together and actually been traveling all over the world teaching this content, especially in China and the Philippines. And people are buzzing all over to see this. And Andrew mentioned this is a practical course. He's made it, designed it for his nieces and his family because they're the people he cares about, and he doesn't want them doing the wrong thing with their money. So you can see that now. Now, for the people watching this webinar, this course is normally $99. And while we're watching the webinar here, you can actually jump in there, click on where it says Make Me Financially Independent. You can see the webinar code there. Webinar 230415. That's webinar 230415. Put in that code and you're going to get this course for $20, $19.99. That's 80% off, only for the webinar, people watching the webinar now. But I tell you what, it's going to be the best investment you do. So anyway, that's enough from me, Andrew. I'm going to hand it back to you, and you can take it over. The time is yours now.
Okay, great. We've already got some questions coming in. So before I get to those, but keep them coming. Before I get into those, I'm gonna talk a little bit about the subject matter. And really, I've tried to narrow it down to as simple as I can get. And what I want to talk about is the first 3 or 4 of the points that I make. And the first one really is that in order to be successful pretty much in almost anything, you need a written plan. And finance is no different. In fact, you could write a written plan that I'm talking about here on a piece of paper, like, how about toilet paper? Well, for my students that are taking this class live, I have them write their financial plan down on an index card. Part of the message I'm trying to get across to them is that this plan doesn't have to be huge. In fact, it's better to keep it simple. What I've learned and what we can learn from research is that most people are overconfident, and they believe that they can do it without a plan, or they think that later I'll have more money. And so what happens is people put it off. And so the majority of people in this world don't have a financial plan that's written down. So the purpose of the course really is to get you writing down your financial plan. So that's point number 1 of the course. The second point is about simplicity. In the financial world, everybody's trying to make it so complex. And some people aren't trying. They're just really bad at making things simple. But then there's a whole nother group of people that just make it complex for their own reasons. You know, the less that a client knows, maybe the more that they can benefit from that. But also just think about going to see a doctor. You know, they may talk about terms and things that you just don't know anything about. So it is possible that they could be very complex, even though they're just doing their job. So what I try to focus on is simplicity. We only need about 6 things in a financial plan, which I lay out in the course. But you know, the things like we need to understand, and one of the most important things probably of this course is that you need to understand your investment horizon. And if you're 25 years old and you want to retire when you're 65, you've got a 40-year investment horizon. That's a huge amount of time. And over that time, you've got to manage your money as carefully as you possibly can to make sure that you've got the money at the end of the time to retire on. So when you think about a 40-year investment horizon, it's just massive. And when people come to me and talk to me about how they want to make quick money in the stock market, what do I think is going to make money in the next couple of months? It's a bit ridiculous, really, when you think about the journey that they're on. But it gets even more ridiculous when you think about the idea of the retirement horizon. If you retire when you're 65 and let's say you live until you're 85, that's another 20 years you have to support yourself. So not only do you need to be managing your money to build up your wealth over 40 years, then you need another 20 years that you're going to be managing that money. So we're talking about 60 years, guys. This is not a get rich quick thing. It's not something that you can catch up when you're, when you're older. You need to start now. And if you haven't started now, now's the time to get started. And if you have children or relatives, you want to tell them about this and the idea of getting started as soon as possible. So I'm going to look down a little bit because my computer is kind of down. So let me just go through and look. I got some questions over there. But okay, the next thing is that you got to start early because time really is money. This course is aimed at people that are young. I mean, if you're 50 years old at my age, let's say, and you come to me and say, I never saved and I don't know what to do. Can you tell me what to do? It's a hard discussion because if you want to retire 10 years from now, I mean, you got to make a hell of a lot of money and you got to invest it very well. It's unlikely that people are going to have the money they need for financial independence at 65. Hence, the majority of people are just working and end up that they'll work most of their life. If you look at the statistics, at least in America, what you'll see is that the majority of people have almost no savings or investment. So they're in for some trouble. But the reason why time really is money is because if you can invest your money when you're young and you can let that money grow over time, what you're going to find is that it will eventually grow exponentially. So what do I mean by that? What I mean is that in the beginning, as you're contributing money to your investments are going to be rising, let's say every month by another 100 or another 500 or whatever it is. And there's a little bit of interest or a little bit of dividends that you're going to earn from that over that time, but it's not going to rocket up. But what you find is that after 20 years, that increase every single year starts to really go up at a very fast pace. As we say, it's an exponential rather than a linear rise. So you've got to leave the money in for a long time. And that's why point number 3 is about time really is money. Now, the next point is that the majority of people that come into the stock market are sadly mistaken about the returns that they could make in the stock market. I was giving a lecture in China, and a guy raised his hand when I asked the question, how much do you think you should earn in the stock market every year? And he said 30%. And I asked him, why did he think 30%? He said, well, I earn 30% in my own business, so why would I invest in the stock market if I didn't earn that amount? Well, the sad truth is that if you look at the long term, China is actually a disaster, right? China is maybe on average over the last 20 years, despite it being the fastest growing economy in the world, on average, it only grew about 6% per year. But let's take the US as an example. What we would see is that in the US, the stock market grew by about 8 to 10%. Recently, it's been a little bit better, but from a long-term basis, you probably want to think about 8 to 10%. And of course, if you want to be conservative and you don't want scary surprises, you probably don't want to think 10%. You probably want to think, I'm going to expect 8%. So if there's one message you get out of this discussion that we got right now, that is 8% is what you should expect from investing in the stock market over a long period of time. Of course, one year you may get 30%, and another year you may get minus 30%, but over a long period of time, you're going to get about 8%. So that's point number 4. And I think that those 4 points right there are really a big core of it. And once you get your head right, you've got a written plan. It's as simple as possible. You started as early as you possibly can, and your expectations are set right. Now you're in the right frame of mind. And this is why the material in this book is part of what I'm writing, or in this course is a book that I've written and will be publishing soon called You Won't Get Rich in the Stock Market Until You Change the Way You Think About It. So right there, those 4 points and those 4 steps basically are things that I want you to start changing the way that you think about the stock market. So maybe, Stuart, I think I'll stop there and I'll go through some questions. And then after that, I can go back into some of the other points. How's that?
Yeah, that's great. And don't forget, everybody, you can probably see right there, or actually you will be in about a few moments, you'll be able to see the offer coming up there, especially for people. Wow, we can see people clicking in already on that offer, 12 steps to financial freedom. So basically, Andrew's teaching all of this, all of the stuff that Andrew uses in real life, you've got in this course for 20 bucks. That's 80% off just for the people in this webinar. So click on that button that says make me financially independent. Click on that, use the code there, webinar 230415, and you'll be able to get 80% off just until tomorrow for the webinar registrants using that. Yeah. And that's great. I can see the questions are coming in now, Andrew. Okay. I'll tell you what, how do you want to do this? Do you want me to ask you some of the questions, or do you want me to
go ahead? Why don't you ask? And before I would add on to what you just said, Stuart, is that, yeah, it's a crazy low price, 20 bucks. But also remember that I'm revising this material and improving it all the time. And once you come in as a student, you basically have almost lifetime access to that course and the materials as I continue to improve them. So it's a great way to keep the dialogue going in the course. So Stuart, why don't we go ahead? What's the first question you see?
Okay. So which passive funds do you recommend, Andrew?
Yeah, it's a question that's a difficult one because in this course, as well as my book, I'm trying to kind of address the world. And when you're addressing the world, you have to kind of think about basic principles. If I was to talk about specific mutual funds, passive funds, ETFs, the problem is that in one country they may be available and in another country they won't. So the first thing is that it depends on where you're living. If you're living in a place like the US or the UK, they're very sophisticated financial markets. Everything's available. If you're living in a place like China or Thailand, as an example, you're going to have much more limited. So let's just talk about the best opportunities that I can see in the markets that have the most opportunity. And that the ETF or fund, that ETF and a fund is basically the same thing. It's just a little bit of difference in the way you execute it. But the one that I like, and particularly the ones that I've got my nieces to look at, is Vanguard. Vanguard is a company that's actually a not-for-profit, essentially, mutual fund company. And as a result of that, any additional profit that they make in their business, they reinvest into the funds, allowing the funds to reduce costs. So pretty much almost nobody can beat that. So there's three main groups of funds that I can see: Vanguard, Fidelity, and then Charles Schwab. The one that I recommend for my nieces is Vanguard, although Charles Schwab and Fidelity also have a very, very low cost ETF. But then I would say that you probably want to look at the VT fund. VT fund, you can type in the code V as in victory, T as in Tom, and then Vanguard. You can go to that and see that it's basically owning every stock in the world. And so that's one of the most important things, is diversifying. So that one is the most diversified fund. So if you ask me about it, that's the fund that I would look at as a starting point, and then, you know, check around before you make your final decision.
That's great. So basically with those, you could be potentially owning all the stocks in the market.
Yeah, exactly.
So, okay, we have another question in here. So supposing you just inherited $40,000, what should you do with it if you've got this lump sum of money?
Yeah. Yeah. So to answer that question, let's think about the opposite of that. And the way that most people invest their money is that they take a little bit out of their pay every month if they can, or if they're disciplined, or if they've automated that. And basically they are contributing every single month. And that's what most people do. And the result of that is that you're just trying to put money in on a regular basis. You don't have to worry too much whether the market's up or down, because whether it's up, whether it's down, you're contributing over time. But when you have a lump sum where maybe you get an inheritance, then you have a little bit of more of a worry that you put it in at the wrong time. Let's say when the stock market is really, really high. There's really no, and this is kind of one of the things that I've learned in my years in the world of finances, nobody can accurately time the market over a long period of time. And so because of that, what I would say is that you may break that money into some smaller bits. Maybe if it's 40,000, maybe you put 20,000 in 1 month, another 20,000 in 3 or 4 or 5 months later. You could do something like that by breaking it up. Of course, if you break it up and then you find out that you actually start getting tempted to spend the money, then it's probably better to just put it in as a lump sum. The most important thing is that you've got to get your money into a well-diversified fund or ETF, and you've got to leave it there. Think about, if you want to get to financial independence, you got to never be a seller of your money. You want to buy the fund or buy the ETF that's the most diversified as you can get, and then own it for the longest time that you possibly can.
Fantastic. Okay, we have another question here for you, Andrew. What should we include in our plan? Like, should we, you know, supposing now you're still planning, but you're not married, you haven't got a baby yet, a house. So what about those things? What things should we take into consideration for the future when we're making our plan?
Yeah, well, some people I've talked to, their plan is just one line. They say, marry a rich person. That's the fastest way to financial independence. But for the rest of us, there's a few things that you're going to put in your plan. And in the course, I'll go through 6 different items, but maybe I'll hit the main ones right now. The first one is you need to know your investment horizon. And we need to visualize this so that you don't start thinking short term. So if you are, let's say, 30 and you want to retire when you're 60, your investment horizon is 30 years. The second thing that you want to know is your retirement horizon. If you retire when you're 60 and you're going to live till you're 90, then your retirement horizon is 30 years. So we have 30 years investment, 30 years retirement, 60 years is your total investment period, basically the period of time that you're going to manage your money. The other thing that I would say is really important is that you need to think about, you can't just own stocks. There's a really strong benefit, which I explain in the course in more detail, of why you should own bonds as well as stocks. But I can summarize it by saying that bonds are a little bit lower returning. So you're going to lower the return of your portfolio. But with bonds, it's going to dramatically reduce the volatility of your portfolio, meaning your portfolio is not going to bounce around as much. To give you an example, when the 2008 crisis happened, my mom and dad had about 80% of their money in bonds because they're retired. That meant that when the markets crashed, only 20% of their net worth fell by, let's say, 30, 40% during that crisis. So they just could wait that out and let it come back up, and then they were fine. But imagine if all their money was in the stock market, they could have been crushed. In fact, they could have panicked and sold when the market was down, which happens all the time. So I'm going to give you a formula that's in the course, and it's also in the financial plan, and that is 110 minus your age. So 110 minus your age. If you're 20, as an example, 110 minus your age is 90. That means 90% of your money in your 20s should be in the stock market, 10% in the bond market. And you don't need to change this much. You just say 110 minus your age when you're 30, and you now are going to go from 90% stocks to 80% stocks. And throughout your life, every decade, you start to adjust that. So that's another thing that's in the plan, and it'll all be laid out in the course.
So 110 minus my age. Wow, that's not leaving a lot of time.
That's 110 minus 27. What is that, Stuart?
That's right. It's yeah, actually, yeah, I calculated the wrong number. Okay, so is in say we're here in Asia, is there any better country right now to be investing in? Do any countries have an advantage over another?
That's so this is a question that can help us to go into another subject, which is the concept of active and passive investment. With active investment, what's happening is that a person is trying to time the market. They're trying to say, okay, I want to be in Indonesia now. Oh, now I want to be in Brazil. Okay, now I want to be in the US. And they're rotating their assets around based upon this concept of timing the market. Or they may time sectors. They say, oh, I think it's a good time to be owning banks. And then later they may say, I think now I want to own oil companies. So this is either country or sector allocations, or moving within these sectors or countries. And then, of course, you've got it down to the stock level, where you may say, I like these 5 stocks, and I'm getting rid of this one, and I'm adding this one. All of the things I've just described at a country level, at a sector level, and at a company level or a stock level, all 3 of those things involve the same concept, and that is trying to make a bet, trying to time the market, trying to guess when to get out of one and when to get into another. So this is called active management. And this, even the professionals can hardly do. In fact, The academic research is unanimous that the average professional money manager can't beat just a normal buy and hold portfolio. I want to repeat
Wow.
that. I want to repeat that because I've been in the financial industry and I see it. Plus, with all my academic research and my reading of academic papers, I'm absolutely convinced that this is very true. And that is, the majority of financial professionals do not beat the market or time it in such a way that they're adding value through that process. So when I came to the concept of what to do with my nieces, well, first of all, my nieces didn't care about trying to time the market. They're just not interested. So a passive fund was really good for them. Plus, I was able to tell them, don't try to time the market. More importantly, get your money in the market. And that brings us to a passive fund like VT fund that I mentioned about Vanguard. Of course, I don't get anything from Vanguard for saying that, but I just know that it's a great quality company and the products they offer are great. So the point is that a passive fund is just trying to meet or match the market rather than time the market. Therefore, it's much cheaper. The fees that you pay are much lower, and that's valuable over a long period of time. So that's a long way to answer that. In this course, I'm not going to teach you about how to time the market and jump from oil into utilities companies and things like that, because it's a loser's game eventually for the majority of people.
Wow. So what you're saying there, you as a financial expert, somebody who's worked in the market for so long now, so many years now, are saying, but basically, anybody in that job, including your job picking the stocks, you can't pick the stocks any better than the market itself. Is that right?
Yeah, I mean, what you can say is that it's just like flipping a coin, right? If we flipped a coin, let's say we had 100,000 people in a stadium, and we asked everybody to stand up and we asked them to flip the coin, and then we told them, hey, if you have tails, sit down. We know from the rules of statistics that half the people are going to sit down as long as it's a fair coin, right? So 50,000 people sit down, 50,000 people are still standing because they flipped heads. Then we ask the people that are standing, hey, flip again. They flip again, and what do they find? That 50,000 standing becomes 25,000 because 25,000 flip tails and they sit down. If we did this 10 times, we would end up with 1,000 people at the end who flipped heads 10 consecutive times. Was this because of skill? Well, we know that this was because of luck. We understand that a coin flip is a 50-50 option. So when we talk about the financial market, we have to think about the concept of this statistics or luck, that every year there's going to be half the group that does better than the other half. So someone may say, oh, Andrew, my portfolio manager or I beat the market this year or that year. But what I know is, remember, we have an investment horizon of 40 years. The probability of you beating the market over and over again is very, very low. But still, it's possible. Remember, we had 100,000 people standing and we went down to 1,000 because some people flipped 10 times in a row heads. Well, there are people like Warren Buffett, as an example, who have flipped heads many, many times. And so I'm not saying that there's not winners and losers. There's always winners and losers. And I'm not saying that there's not a small number that actually win for a long time. But what I'm saying is that majority of that can be attributed to luck. And this is where, you have to think about it, Stuart. Think about this, who do they interview? The guy that flipped the coin 10 times in a row heads, they like, how did you do it? He said, well, I said a prayer every time I flipped. Right? But do they go and then they ask him, hey, you ought to write a book about what you do. And he thinks, yeah, that's a good point. You think people would read it? Yeah, because you flipped 10 times in a row. But nobody goes and interviews the guy that flipped tails 10 times in a row and goes, how did you lose every single year? Maybe you should write a book about that. No, we focus on the winners, and that distorts us a little bit. So it's a long way of kind of getting to the answer, and that is the idea that we do have ups and downs, but I wouldn't be trying to pick the market or time the market.
Wow. So that they're new interest and they're new insights for me to hear that, and actually hear a stock market or a financial professional saying that financial professionals don't actually have any real skill in more skill than anyone else.
It's a paradox, because when you think about it, if you're going to build a house, Stuart, you're going to want to hire an architect that's 1 year out of school? No, if you could get a guy with 30 years of experience, you do it, because you build upon your years of experience. In the financial world, if you had someone managing your money, I would say you want to get someone that's very experienced. But I would also say that the financial world is not governed by the same world as a dentist, a doctor, an architect, an engineer. There are rules and very specific guidelines. If you're going to build a house, there's a load factor. You can build a roof that's like this, but if you start to try to build a roof that gets flatter and flatter, the rules of engineering and architecture tell us that your walls have to be in. And so they're very, very clear and concrete physical laws of nature. In the financial world, it's just too many. It's millions of people coming together, constantly exchanging information. It's too complex for any one person to consistently beat it, except for sure by luck and maybe a tiny number by skill.
Okay, so before I continue on that, because you've got my mind racing and thinking now, and I'm seeing questions coming in too. I'll just put that offer up again. If you like what you hear, there's a lot more where that came from. Andrew's got his course just launched tonight on Jcademy. That's 12 steps to independence. To financial independence, sorry. You put the webinar 230415 code in there, and for only until tomorrow, you'll be able to get that 80% off. So it's $20 for Andrew's entire course that normally sells for $100. Okay, so getting back to that then, let me ask you then, you've just told us that people can't pick stocks, but that's what you actually do for many clients. So why should people listen to your stock picks?
Oh, that's too tough of a question. So when somebody asks me a tough question, my strategy is, rather than answer it, I think I'll ask another question. Are you ready for my question for you?
Okay, that's a bit scary.
Let me ask you a question about, let's say in Asia, and certainly in the West, people go to casinos, right?
Right.
What percentage of people know this saying, do you think, when they go to a casino? The house always wins.
Well, from having worked in casinos in a previous life, in marketing, I can say that nearly everyone does, but everybody that goes in there still thinks that they could get an edge by doing something.
Right. So the point is that people know that the casino always wins. It has to be over time, or else the casino will go bankrupt. Now, people also know that there must be winners too. If you saw a casino that never announced that, hey, someone just walked out with $1 million, who's going to go there? So what you have to do is entice people with the occasional winners who win big to overcome the reality that the house always wins. So the stock market's a lot like that, because we talk about winners. Everybody loves to talk about, oh, I bought that stock at 100, I sold it at 200. People love to talk about their winners. So we have a similar type of thing going on. But let me ask you a question now. This is my question to answer your question. So if majority of people knew that the house always wins, the casinos should be empty. So let me ask you, are the casinos empty?
No, because you get free lunch, free airfares, and free rooms.
Woohoo! So basically, the casinos aren't empty because people need to trade in the stock market, in the casino. People want to play. People want to think that they're going to win. So although this course content that I do is for my nieces, and it says, don't go into the casino, just invest very carefully, invest as much as you can over a long period of time. After 20 years of working in the stock market, people ask me, Andrew, can you take care of my money? I don't want to be bothered with it at all. Or maybe you could beat the market and I could be the millionaire that gets announced that I, made a lot of money. So basically I serve both groups. And for 20 years, I've served this group that wants to invest in the market more actively. And I've put together everything that I've ever learned in my head. I've put down in a methodology. Basically, I've programmed everything I have in my head into a methodology. And that's the way that I invest other people's money who say, hey, I want you to take care of my money and help me grow it. But I tell them the same thing. You could also put your money in a passive fund. They're like, part of my money's in that already. I want to try to win. So for those people that really want to try to win, I do my best to try to serve that need. And, I do outperform, but part of that's because I know the truth about what I'm saying in this course. So for all my career, I've been actively managing money and seeing the realities there. Only the last year or so that I've really come out to talk about this book and this content.
And I've been actually following one of the funds that that you advise on, and it's way above ahead of the market at the moment.
Yeah.
And you say this is based on your methods, your systems. What do you go in there and you get to know the CEOs, or you go and investigate every company, what's happening there? What makes your system different?
Yeah, and I think that, it's important. I'm glad that we're talking about this because it's important for people that are attending this to know that this course is not about my system and about how I invest. This course is about how majority of people should be investing their money. And that is, they should be very careful, investing it very diversified, that type of thing. Now, the thing that I would say is that if you are going to give your money to somebody like myself, as an example, to actively manage that money, the first thing is that unless you know a lot about the world of finance, I wouldn't recommend that you do that. I'd recommend that you try to take care of your own money with passive funds and learn how to contribute. Maybe after you've built up a nest egg of $300,000, $500,000 of passive money, maybe then you take a little bit of it and start playing around. Maybe that's okay. But there's a bigger reason, Stuart, and in the book I talk about this, and that is there was a guy that did a study who went back over 35 years. And what he did is he looked at all the funds that were available. So if you were sophisticated enough, you were able to go out and find all the people like me, Andrew Stotz, who's managing money. And this was long before we had a lot of the financial innovations that are very helpful for us, like passive funds. And let's just imagine that there was 100 people managing money. So there's 100 different funds. 35 years later, he tried to measure which one of those funds survived. And then from those, which one of those actually beat the market. And what his work showed was it was about 7 out of 100 survived and beat the market. Right now, there's more than 50,000 funds in the world. There's not 100. So my nieces would have to somehow get together information on 50,000 funds and try to somehow figure out which 7% of that is going to outperform before it outperforms. You can be massively rich if you could have invested with Warren Buffett 30, 40 years ago, but you would have had to put the money in before he outperformed. So the point is that for majority of people, you probably shouldn't be investing in an active fund. If you are investing in an active fund, there's a few things I would recommend. Number one, that you find somebody that is very experienced, because an experienced financial professional knows the most important thing, which is that it's more important to manage your risk than it is to try to get a higher return. The second thing that you should look for if you were going to actually manage your own money, by buying stocks or going to an active fund manager is that you want to find someone who has a stop loss methodology. And that basically means they have a plan of what they're going to do when a stock falls. So 30% of the performance that I get comes from that. But again, the course is not about that, and I don't even spend much time in it. But since we've got a one-on-one chat here with the audience, it's a great question that needs to be addressed. And that's my best answer about active versus passive in my own style and what I do. For this course, for my upcoming book called You Won't Get Rich in the Stock Market Until You Change the Way You Think About It, it's really directed towards the beginner. And let's say to some extent, some sophisticated investors need to see it so they realize that they may not be outperforming as they think.
That's a that's a catchy title. You won't get rich in the stock market. I'm sure it's going to get a lot of people's attention. I've heard you mentioned it earlier when you were talking about
I lost Stuart. Can anybody in the audience hear me? I'm looking at the chat. If you can see, if you can hear me, let me know. Okay, so I'm getting some messages that you can hear me. So that's good. We cut Stuart out of this. That was the plan. No, just kidding. So what I want to do is let's look at some of this questions that I see. Someone asked the question, what about Warren Buffett's rule number 1? So I'm going to talk about that for a second. Let me just ask you, can you hear me? I just said Warren Buffett's rule number 1. Just let me know by typing in. All right, great. Bingo. Okay, so what do I think about Warren Buffett's rule number 1? Warren Buffett's rule number 1 is never lose money. Warren Buffett's rule number 2 is never forget rule number 1. And what I've learned is that maybe 30 to 50% of long-term performance in the stock market comes from trying to prevent yourself from losing big amounts. And that's critical, because if you had 100 and you lost 50%, you'd be down to 50. You'd have to go back up by 100% from 50 to 100 just to get back to where you were. And so basically with rule number 1, what I would recommend for anybody who's investing is that you want to pick a point that you're going to give up on a particular stock or something like. So this is mainly about investing in stocks, not investing in funds, because there's a difference here. When you invest in a stock, there's a possibility that a stock could fall by 30, 40, 50, 60%, and it could stay down. But with a fund or the overall market, one piece of research I did is I looked at if a fund went down or the stock market went down, in 5 years, what's the probability that it will have been back to where it was? And the answer is about 85%. Within 10 years, it's guaranteed. You're basically 100% sure in the past that the stock market has come back. So what I like to say is stocks can crash and not bounce back, but the market tends to always bounce back. So what I would say in this case is that Warren Buffett's rule number 1 is telling us preserve your capital, particularly when you're investing in individual stocks, because they can really crash. Now I lost the chat function here. Let's see if I can get it back. Enable chat. Whoops. Okay, so I just tried to explain Warren Buffett's rule number 1. Did you catch that? I think it was Alex that asked that question. So Alex, did you hear my answer to that? Oh, Lizzie. Lizzie's asking about gold. Lizzie must be, I suspect Lizzie's probably a woman given that name. And you're thinking about gold. Ah, yes, interesting. Gold. Let's talk about gold for a minute. This means what we can call it asset classes. Asset groups or classes are stocks, bonds, commodities, property, gold. Those are different asset classes. What I explain in my in the course and just in my general teaching is that the only 2 asset classes you need to worry about are stocks and bonds. And